The next one we'll talk about then is the institutional lenders, oftentimes referred to as hard money. I think hard money, a lot gets kind of encapsulated in hard money, so I like to use institutional lenders. But these are the types of lenders that are, they're running a business of lending money to real estate investors. You'll know you're working with an institutional lender because they'll have a website, right? They'll have branding efforts. They'll be doing marketing. They may have salespeople. They'll look and feel like a business that is in the business of lending capital to real estate investors. And some of the pros of dealing with these types of institutional lenders is most of them, not all of them, but most of them are going to have nearly unlimited amount of scale, right? So they're going to have a very large amount of capital in one place. And so long as you can prove to them that you're a capable operator and you've performed previously, in most cases, they're going to have all the money you could ever want for to really grow your business, which is, I think, a huge positive. The other good thing about institutional lenders is the good ones will bring a certain level of expertise, right? So they'll have, whether it's their sales team or their underwriting team, almost co-underwriting the deals with you, right? Looking at the different comps that you're looking at, looking at your statement of work and making sure that you're thinking through that appropriately. They understand the space really well, right? So they're going to bring a certain level of expertise to your business that's going to help you think about things the right way and continue to level up. The other nice thing about these institutional lenders is they're generally well-resourced, right? So they have teams, they have salespeople, they have real estate analysts, they have closing specialists. They've got customer service and servicing representatives. So again, this is going to be very dependent upon the lender, but you can get a very white glove feel, right? And that can help you really, again, not have to worry about the capital and getting the deal closed because these companies are well resourced to help you actually accomplish that. The last thing here is they can be very cost competitive. So over the years, a lot of capital has come into the real estate market, and I'm primarily talking about the residential single family 1, 2, 3, 4 family market. There's been a lot of capital that's come into this market, and that's really helped bring down the cost of capital. So this can be a very competitive way to also raise capital. I guess this is my last point that I also want to hit is they tend to be a little bit more hands-off so long as you're again, doing what you're supposed to be doing and moving the project forward, right? So most of these institutional lenders don't care what color the paint is or how you're designing the kitchen. They're counting on you to understand your market, understand what's going to sell and what's going to get the most value out of that property. And they're really there to just help you with the capital to grow your business. On the flip side of this, from a cons perspective, is you're going to go through some additional due diligence with an institutional lender than you might with, let's say, a private money lender or certainly your friends and family. There's going to be an aspect of probably a credit check, probably a background check. They're going to want to see things like bank statements. There may be third-party appraisals required. So there's going to be a little bit more hoops to jump through, have access to this type of capital provider, but oftentimes can be well worth it relative to the things that they bring to bear. The other thing here is the institutional lenders perhaps can be a little bit less flexible. So if you're dealing with a local private lender or your friends and family, certain aspects to the deal that are a little bit more challenging, the institutional lenders may or may not be able to do anything with that, right? So they're all that capital that's come in and support these institutional lenders to some extent have very specific requirements, right? So oftentimes the deal doesn't fit those requirements. There's going to be some limitations into what they can do for you. Most institutional lenders are also going to require personal guarantees. What that really means is, the real estate property is generally going to have to go into some type of entity like an LLC, and then the lender is also going to ask you to personally guarantee that loan. So if the loan doesn't go as well as you expect and as well as the lender expects, they're going to have the right to actually go after your personal assets, which sometimes that exists in the private lending space, probably not with your family and friends. But is a very, very common practice once you get into this institutional level of capital. The other thing that could be different for institutional capital relative to friends and family or private money is if there's a part of the loan that's being held back for the construction draws or the renovations of the project, that money is likely going to be held back into a separate escrow account, which you're going to have to complete work against before you can access that capital. Oftentimes with private money or family and friends, you'll get all that capital up front, or it'll sit with title or a different place and gets drawn as the work's done. Institutional lenders are going to have a process around how you can access that capital depending on what their process is. And we'll talk a little bit more about that in a bit. Somewhat unique for most, again, these institutional capital partners relative to family and friends and or private lending is most of them are going to require some amount of experience. So they like to see that you've completed a project or two previously. because it's the best way for them to understand that you have an ability to execute and perform the way that you say you're going to perform. So oftentimes, if you're, again, just getting started, institutional capital may not be the best place for you because most of them are going to require some level of track record. And the last thing on the institutional lenders is nearly all of them require some amount of what we call skin in the game, right? So they're going to give you some loan to value ratio or some loan to cost ratio that ensures you have some of your money in the project. And the reason that they do this, and we like to do this, is it creates an aligned incentive, right? We want to make sure that we as an institutional lender are lending you, let's say 85% of the cost of the project, you've got 15, and we're both aligned in making this project successful, and you get your money back plus a return, we get our money back plus a return, which again, there tends to be a little bit more flexibility with those loan to cost or loan to value ratios when you're in the private money or friends and family market.